Well, thank you very much for the invitation. I want to congratulate Álvaro, Diego, and Sofia. They put together an excellent conference. I mean, so far it's been very interesting. I learned a lot, and I look forward to the rest of the talk. So before I start, the usual disclaimer applies. Whatever I'm going to say, it's my own. It's not IMF management, IMF board, IMF staff, or nothing related to the IMF, my own words only. Let me use just one quick slide to make a part of the summary of what the paper is about, or at least the main things that I pick out of it. Number one is, the main question that the paper addresses is to try to assess, and as Álvaro very nicely put, taking into account causality issues that might be around, but try to look at what's the relation between macroprudential policies and capital control policies on capital inflows, on the one hand. And number two is try to delve a little bit deeper into understanding what could be the driving, the underlying forces that drive these movements, or this relation between macroprudential policies and capital control policies, and capital control policies in capital inflows. And the paper is lots of very interesting results, so I encourage you to read it. Not only the results are very interesting, it's very compact, so it's not that you have to read a 80-page long paper to learn a lot. So it's very rich. The wealth of results is very interesting. I like them a lot. Some of the key results that I would like to highlight that Álvaro already mentioned is, on the one hand, suppose you tighten macroprudential policies, the ones that act through financial institutions, basically those that work in trying to build buffers for financial institutions, such as dynamic provisioning and the like. What you find is that tightening those types of macroprudential policies, you observe they reduce the bond-related capital inflows when you look at advanced economies, but they increase the bond-related capital inflows if you're focusing on emerging countries instead. Where another result is that if you tighten the macroprudential policies that are more related to protect or try to work through borrowers, loan-to-value, debt-to-income ratios, etc., what you see is that borrowers, I mean, this tend to increase capital inflows, bond-related capital inflows, when you focus in advanced economies. One of the driving mechanisms that's behind that, the story that they work on, is that, or the way I interpret the results, is that, well, economics and finance hate vacuum. They try to fill it. So if for any reason macroprudential policies will try to tighten to, say, reduce domestic demand pressures, credit growth, and the like, in an era in which non-financial institutions have a much more ease or ability to tap global financial markets, financial integration has increased, monetary and fiscal and macroeconomic frameworks in general have improved. Add to that, more recently, QE, although they focus until 2013, not the entire period, but some. I mean, bottom line is that the story would go that there's a carry trade story in which, in a sense, or the way I interpret the results is part that these non-financial firms will do the job. They will go borrow, and then they bring the capital inflows, and maybe affect domestic credit if necessary, but bring the capital inflows as a sector. And then also that domestic credit is affected in emerging markets, but not so much in advanced economies. They also have some results that the impact of macroprudential policies tend to be stronger within, I call them EM, but developing countries, the way they call it, for those that have deeper financial markets. And then they have some results of capital controls. I may have looked at the old tables, but mostly, I mean, and Álvaro did not emphasize those, but I think it's just interesting. Number one, I mean, being in Chile is the right place to talk about capital controls on inflows. Usually it's used as the poster child of to analyze these types of things, same as Malaysia is for outflows. Not only that, but many of the contributions to the literature are from people in the room or in the country, on the central bank. But one of some of the results that they get is that capital controls tend to help in reduce the volatility of equity flows, to increase capital inflows when looking at advanced economies or when there is an effect, mostly there's not, and to lower inflows in EMs when you include equities as well. That's in a nutshell. Again, there are many more results. I encourage you to go read the paper. This is just some of the main I want to talk about. So my comments will be structured basically in what I like a lot, and then my role is also to try to be the bad guy. Problem is, there's not much to criticize, so the only thing I can do is just to throw in some suggestions for the authors to consider, or just to react to me and tell me what I'm missing, and then just wrap up. What I like I said, the paper is very insightful, is full of results. They're very, very, very interesting, and very importantly, this is a relevant policy questions. This is a paper from the central bank. I'm from the IMF, so that's the main thing that attracts, that you can think about policy using these models. Another thing that Alvaro didn't emphasize much, but as you know, most of the existing literature on capital controls basically find that they don't work. I remember a few weeks ago there was this conference at the fund, and Jose Gregorio was saying, well, I used to, or the way I interpret his words, not literally, but I used to believe in capital controls until I did some research, and I stopped. That's my bias, so let's be straightforward about that. What you tend to find is that capital flows, if anything, may help to extend the maturity flows, reducing hot money types of flows, portfolio, increasing more FDI types of flows, maybe gaining some monetary policy independence in the context of the trilemma, but that the impact of these controls on reducing the pressures on exchange rates or on reducing the flows themselves is basically not there. Not only that, I remember once I was talking to people in the market, and I mean, I presented a paper on capital controls, and then this guy approached me saying basically they don't work. And, at the end of the talk, a person approaches me and tells me, you know, I am the chief economist for emerging markets in, I don't know, Berkeley, San Francisco, and I know you're right. And I know you're right because we have staff lawyers that sit next to me, and whenever there is a change in the law, within the week, they find the loophole, and there's no more capital control. No, not only that, he explained it, but I didn't quite understand how, but the investment banks tend at that time to sell some products that would effectively be hot money, but would be disguised in the balance of payments as FDI. So even the results that we know, maybe not as strong as we think they are. Then I'm very happy that they don't find many results supporting capital controls. But even what they find, I think it's fair enough that at least there's more targeted and more narrow what they do. And then I can think, even though I don't like them, maybe there's something there. And also that they are a result or something that they stress throughout this thing that Alvaro was saying about causality. They control for that to the extent possible, but they are very straightforward that, I mean, it's not so easy to control for that. If anything, we can think of that, that's why some of the results may be opposite. We can think about correlation for sure, and then we see how much we can explain out of that. So some suggestions. When I started looking at the paper, like I said, there were too many results, and some, at first sight, were apparently contradictory to me. I mean, if I read a paper and all the results point into the same direction, I say, well, I get the story straightforward. Here I was a little bit confused. And the thing is, the no causality issue is correct, but sometimes I was a little bit lost in some, say, you get this capital inflows, you have says tightening macroprudential policies on the ones that are buffering financial institutions, and depending on whether you look at advanced economies or emerging markets, the results may be opposite. When you look at MPPs on borrowers, only you find some results in advanced economies, if I put it right. Capital controls, again, sometimes the results are there, sometimes are not. Sometimes the results depends on whether you are focusing on bond inflows or or if you include equity inflows. Some would presumably look at the way my bias would be that you tighten and then you lower capital inflows, but then you have the carry trade story. So then I think, well, maybe I can contribute by writing a model to try to rationalize that. This is the model, so I was unable to write the model. But for me, I would encourage the authors with more time to try to have a very simple stylized model that could help at least guide me. So when can I expect this or that? That would have been helpful. So I would like to see that in a revised version of the paper. Some other suggestions. Maybe I'm wrong here, but the way I think about policy is not necessarily on the level of the say, macroprudential or capital control for the case, but on the change. So suppose the following thought exercise. You see more capital inflowing into your country, you tighten capital controls, or you impose macroprudential policies because you think that's the right thing. So my natural inclination would be to think to look more at the change in this variable, the ones that they actually use for the to control to control. But and actually the thetas, the gammas and the thetas hats, I think they might be more relevant. Maybe I'm wrong, but I was expecting more to look at changes in these variables as trying to help me understand. Even if the causality goes one way or another, whether you increase, say, capital controls because you see more flows, or because flows come because you increase your capital controls, and then there's or macroprudential, you see there's a carry trade story. I think it's the change that I would be more interested in looking at rather than the level. I'm short of time, but I can borrow his 5 extra minutes, right? No? Give me some. So of course, they do the right thing at looking at adding these time dummies to try to control for global factors. And they split the sample as well, because we see that capital flows were very different before and after, but very large. I would have preferred instead to look at directly a control for capital inflows, because the time dummy maybe not, but maybe capturing many other things at the same time. So then I would be neat at least to have a table to saying what are the effects of capital inflows to try to account what the global financial cycle is doing, particularly because sometimes you can think of this binary MPI being constant, and then how can maybe I cannot attribute all the changes in capital inflows to the policies, but purely to global capital flows, and maybe the time dummy could not be capturing that. And then look, and then you can look at the effect directly of the policy on capital inflows, and then we can think about interactions as they do when they do the macroeconomic policy. Also, you can look at terms of trade or real exchange rates in order to try to capture better what would be country time dummies. I would also run out of time. Other suggestions would be to also try to include specifically policies, the macro framework. Because the government might be borrowing, and that could be affecting capital inflows. The government might be borrowing within a government that's very sustainable, and that's the market perceives as very strong fiscal policy, and maybe not. And that should presumably have some impact on the volumes of capital that you see coming into the country, the credibility of the central bank. monetary space, right? Because sometimes, particularly when you think about a small open economy, if you need to tighten interest rates, you cannot do that, because that would add inflationary pressures, and then you use macroprudential policies, and then maybe you want to look at that, exchange flexibility and how much financially integrated you are. I'm almost there. I'm starting in my negative time, but the same for carry trade. The story is the carry trade story. And I know what Bruno and Shin did, but I think an additional thing that I would do is for me, carry trade is just bare bones interest rate differential. So I would directly control for that in the baseline instead of the extensions, and then look at what is the additional effect of these policies, or the relation of these policies with this, with capital inflows. And maybe consider what's the specific objective of capital controls, because here what we're seeing is that we're looking at whether they reduce flows, but countries sometimes they don't impose because of the flows themselves, but to gain monetary policy independence or to extend the maturity, so on and so forth. Two things here, and that this will be the last one, is they're working with gross flows. Maybe I would explore as a robustness net flows, particularly because when I think about macroprudential policies, I think of gross flows, but when I think about capital controls, although the results are not there, they're not significant for the most part, I think more of net flows. So that I would have a look at that. And finally, I would be careful with the interpretation in that sometimes macroprudential policies and capital controls get into a very gray area. Because if you impose, say, and I don't know the database by Eugenio Cerruti and co-authors very well, but sometimes you impose macroprudential policies such as marginal reserve requirements in dollars deposits, or loan to value in dollars are different than in the ones that in domestic currency. So then how much of that is actually macroprudential policy and capital control gets a little bit gray. And let me stop there. Again, it's a great paper. I really encourage you to go